Want to follow in the footsteps of the Oracle of Omaha? Like the idea of being invested in a business alongside Warren Buffett? Interested in learning about a financial stock that Buffett's firm just loaded up on? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, if you want exclusive access to my personal six-figure stock portfolio and alerts on any new investments I make, check out the Patreon link in the description below. Warren Buffett is undoubtedly one of the greatest investors to ever live, if not the greatest. We're talking about compounding money at a 20% annual rate for decades. Nobody has done it better for longer. And that's why he's worth about $110 billion even after giving away billions of dollars to charity already. So when Buffett's firm makes moves, the rest of us tend to notice. Now, I do not advocate blindly copying what someone else does. We all have different situations, goals, etc. But it can't hurt to take a look at where some of Buffett's capital is going and whether or not that might make sense for you. Today, I want to tell you about a financial stock that Buffett's firm loaded up on during the first quarter of 2023. Let's dig in. First, let's be clear about what we're talking about. Warren Buffett oversees a common stock portfolio worth over $300 billion for his conglomerate, Berkshire Hathaway Inc., stock ticker BRK.B. Berkshire Hathaway is the company he's controlled as CEO for more than 50 years. While Buffett has two lieutenants, Todd Combs and Ted Weschler, assisting him with the portfolio, Buffett is still the CIO and main capital allocator by a long shot. That said, we can never be exactly sure who bought what. Just something to keep in mind. So, which financial stock has Buffett's firm been loading up on? It's CapitalOne Financial Corp, stock ticker COF. Berkshire Hathaway opened up a new position in CapitalOne, picking up 9,922,000 shares. This position is worth almost $1 billion. This position was opened during Q1 2023, and we know this after Buffett's firm's 13F filing just came out. The 13F filing covers all transactions for the prior quarter, and it generally gets released 45 days after quarter end. The position isn't super large by Berkshire Hathaway standards, but $1 billion is no small chunk of change. Everything is relative. $1 billion for Berkshire Hathaway is almost a rounding error for them, but it would basically be unlimited money for the rest of us. Still, there's value to be had here, and while it's certainly possible, even likely, that Combs or Weschler was behind the move, Buffett's own capital is at risk regardless. That's because as Berkshire Hathaway goes, so goes Buffett. He's the largest single shareholder of Berkshire Hathaway. No matter who made the move, Berkshire Hathaway shareholders are impacted all the same. Let's talk about the business. CapitalOne is a bank holding company that specializes in credit cards, auto loans, banking, and savings accounts. It has a market cap of $36 billion. While you might initially think of CapitalOne as a commercial bank, it's mostly a credit card issuer. When looking at revenue for the most recent quarter, Q1 2023, the credit card business segment generated 7 times more revenue than the commercial banking business segment. Credit cards, classic Warren Buffett. Why do I say that? Well, American Express Company, stock ticker AXP, is one of the oldest and largest positions in Berkshire Hathaway's common stock portfolio, and there is no doubt that Buffett was behind that one. American Express is, of course, a very large credit card issuer. Buffett has long loved this business model, and why not? It's highly lucrative. Consider this: the average credit card interest rate in the US right now is nearly 24%, about as high as it's ever been. Think about that for a second. 24%. Imagine if you could make a 24% annual rate of return on your investments. You'd be a multimillionaire pretty quickly. To put that in perspective, it's higher than Buffett's annualized rate of return over his legendary career. That number is right about 20%. Now, it's not an apples to apples comparison. Also, Capital One doesn't make 24% a year on everything. Some balances get paid off before interest is applied, some borrowers go into default, etc. Still, it's a fat pitch when it does come down the plate. You know what else is a fat pitch here? The low valuation. This stock is uber cheap. The stock's stunning 30% drop from its 52-week high has created a noticeable amount of cheapness. Take the price to earnings ratio, for example. It's 6.1. Single-digit PE ratios are always going to catch one's eye, but this is an especially eye-catching number. It's closer to 5 than 10. Incredible. Since this is a bank holding company, another way to quickly get an idea of the valuation here is to use the price-to-book ratio. The stock's own 5-year average price-to-book ratio is 0.8, which is pretty low in and of itself, yet it's currently 0.6. Capital One is, quite frankly, priced for dismal business performance. But the business hasn't been performing dismally at all. Capital One was able to compound its revenue at an annual rate of 5.3% over the last decade. Earnings per share sports a compound annual growth rate of 11.2% over that time frame. Pretty solid stuff, really. Not lighting the world on fire or anything like that, but relative to the valuation, which is almost seeming to imply there's no growth at all, these are impressive numbers. Huge buybacks have definitely helped to spur some of that excess bottom line growth. What do we know about Buffett? He loves buybacks. All else equal, it's an effective way for a shareholder to gain more equity in a business without spending any more of their own capital. This is another box checked for Berkshire Hathaway, as Capital One has been a prolific repurchaser of its own shares. The company has just been cannibalizing itself. The outstanding share count is down by approximately 34% over the last 10 years. That is huge. Of course, we invest in where a business is going, not where it's been. The last 10 years have been great for Capital One, and the last few years were supercharged by so much free money sloshing around. However, the last year or so has unsurprisingly shown a reversal in some of that growth. Earnings per share for the most recent quarter came in nearly 24% lower year over year. But while we don't invest in the past, we also don't invest for today. We're investing for the long term. Concerning that, I don't see Americans using less credit cards 5 or 10 years from now, which sets up Capital One for a pretty bright future. And you get paid a good-sized dividend along the way. This is yet another way in which Capital One is classic Buffett. Buffett loves his dividends. While Berkshire Hathaway doesn't pay a dividend, Buffett himself almost exclusively buys stocks that pay dividends, and not just dividends, but growing dividends. Gotta love being able to collect growing dividends, but then not pay any of them out yourself. Sweet deal, right? Capital One's stock currently offers a 2.7% yield right now, which is 100 basis points higher than its own 5-year average. The payout ratio is only 16.4%. That's very low, and it provides a nice cushion in the face of economic softening. Unfortunately, Capital One has been stingy with the dividend raises. The company has gone on long stretches without changing the size of the dividend. There just hasn't been the consistent dividend raises that I, as a dividend growth investor, want to see. Quite frankly, I wouldn't be surprised if Buffett is disappointed with this too, as he is pretty much a dividend growth investor himself. Based on that, along with the fact that the position is just under $1 billion, it does lead me to believe that Combs or Weschler made this move. Nonetheless, with all of that out of the way, the current 60-cent per share quarterly dividend is twice as high as it was a decade ago. A doubled dividend is nothing to sneeze at. One thing I don't like about Capital One, the unimpressive net charge-off rates, which tend to be higher than a lot of competing credit card issuers. I'll give you numbers here. The net charge-off rate for April 2023 for Capital One came in at 4.3%, which rose from 4.2% in March. This is actually pretty high when you look at all the other banks and issuers. Take American Express, for example, which Berkshire Hathaway is heavily invested in. American Express came in with a 1.1% rate for April, which actually declined from the 1.7% reported in March. I'm just not a big fan of the credit quality here. Should you follow Buffett and his team into Capital One? Well, that's ultimately up to you. However, there is a lot to like about the business. The extremely low valuation comes to mind very quickly, which builds in a nice margin of safety in the face of a potential upcoming recession. You also get a nice yield, and the buybacks are incredible. However, the lack of consistent dividend raises is a black eye for me, and I'm leery of the charge-off rates, but it's hard to deny the appeal of being invested alongside Warren Buffett. At the very least, it'd be a good idea to take a close look at Capital One here. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this financial stock that Buffett's firm just loaded up on. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So, if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.